Welcome to the Coastal Bridge Advisors 2026 Mid-Year Halftime Report. I'm Bill Loftus, Chief Revenue Officer for Coastal Bridge Advisors, and I'm thrilled today to be introducing our speaker, Coastal Bridge Advisors' new Chairman and Chief Investment Strategist, David Waddell. If you're a legacy Waddell and Associates client, welcome back to a familiar report delivered under an exciting new brand. If you're a legacy Coastal Bridge Advisors client, you've likely not heard David speak before, but trust me, you're in for a treat. This mid-year report is an update to the annual report David delivered to his clients earlier this year. As you now know, Waddell and Associates, along with One Charles, merged with Coastal Bridge Advisors on July 1st. This made David's insights and experience a central part of our leadership, further enhancing the guidance we can offer our clients. Without further ado, I give you David Waddell and the 2026 Mid-Year Halftime Report.
Thank you, Bill, for that warm introduction. Good morning. It is an absolute honor and a privilege to have the opportunity to present this, my 2026 halftime report, to all of you. For those of you who are new to this process, twice a year I disappear for a couple of weeks, read everything I can possibly get my hands on, synthesize all of my thoughts, and produce a presentation that I then provide to the clients to help answer the major questions of the day. But I also use it to help inform the discussions and the decisions within our investment committee. For those of you who are interested in seeing the full 2026 Outlook report, it is on our website at coastalbridgeadvisors.com. But before I begin, I will take you through a quick synopsis of that presentation. I will judge my predictions, and then I'll take us forward from there. The reason I entitled the 2026 Outlook, Prepare to be Shocked, Navigating Realities in the Artificial Economy, is because the pace of technological change happening in today's economy creates great enthusiasm, but also wide concerns. Artificial intelligence will augment many human tasks, but also perhaps replace some as well, making this a moment that's both fascinating and a little bit terrifying. And I get a lot of client questions around that friction. And so in January, as I went away to do my research, I really endeavored to answer two questions. One, is the AI age good news or bad news for the economy and our investments? And then number two, are we entering the best of times or is this the worst of times? Here is what I found. We have gone through many periods of significant technological change. And that has boosted productivity to very high levels and reshaped many aspects of societies. For a technological change to count as a major and significant event, the invention has to boost output per worker significantly. Economists call this a productivity shock. And we've seen several of these throughout history. We had the industrialization in the early 20s. We had the electrification soon after. We had the aviation era where we could get places faster and do business more efficiently and ship goods and services around. And then we went through a period of somewhat secular stagnation in the 70s. The computer came out in 81, and suddenly we had mass adoption of the internet and mobile communications in the late 90s that drove productivity higher. And then we drifted a little bit lower again, and we're seeing a leg up and a lot of potential for AI to carry that productivity higher. These cycles are very important within the economy and can be very beneficial for investors. Let's take a look specifically back at the last 40 years. This is another chart showing productivity. And as you can see, there are certain spikes around the shaded areas. The reason why you see those spikes is during recessions, employers tend to lay off employees before they actually cut output. So it's a little artificial in terms of a productivity booster. But if you zero in on the center of the chart, you will recognize that before, during, and after the recession that occurred in the early 2000s, we saw a significant and prolonged productivity period. This makes a good framework to go back and judge where we are today. If we go back and think about that period, let's get in the time machine together. The heroes of the day were firms like Netscape and eBay and America Online and BlackBerry Windows hit the market. Some of these names you've probably forgotten, but at the time, they were the magnificents that were driving our economy further and forward. Productivity during that period averaged 2.8%, well above long-term historic averages. That boosted GDP during that period to an average rate of 3.4%, also well above long-term historic averages. And based upon the vernacular of the day, the theory is if GDP is running hot, that means inflation's running hot as well. Not in a productivity shock. We actually saw core inflation run about 1.8% on average throughout that entire period. So the mother's milk of the economy is productivity, and from it, you should get higher GDP and lower core inflation at the same time, and that's what we got. An absolutely great framework with which to consider today. So let's pull ourselves forward and look at the period from 2000 through, in this analysis, the end of 2024. Well, productivity has begun running above average and also has been accelerating. GDP has been running above average and also has been accelerating. And though we went through a significant period of inflation, that inflation rate has been declining on average and has actually continued declining into this moment today, despite the war in Iran. And the heroes of this age are names like Zoom, where we did mobile communications, NVIDIA, powering the AI, and then obviously OpenAI and Anthropic, and then most recently SpaceX. We're just going to go to the moon. We're going to put a whole bunch of robots up there. We're going to create space stations, data centers, and then we're going to fly to Mars. Sounds a little crazy, but it's in the mix, and it's got a $2 trillion valuation. So, given all of that as a backdrop coming into our estimates for 2026, we expected that combination of high productivity to create high earnings, lower inflation, and therefore a really good outcome for our investors. And let's see what happened. Also driving our optimism is that if you look at the economy, there really aren't any signs of recession, and there weren't any real signs of recession coming into this year. In years where there are not economic recessions, markets tend to advance 85% of the time. Furthermore, markets tend to advance more than 10% over 68% of the time. And as you can see, in 42% of the years where we don't have a recession, returns can be even greater than 20%. Pretty encouraging. Furthermore, our optimism around economic growth driving earnings bleeds into this chart as well. When earnings growth is above historic average, which we thought it would be, the market typically produces, call it 12.6% rates of return or double digits. When earnings are coming in below average, markets are only producing a single digit rate of return around 6.7%. So we felt good about not having a recession and the odds of a market going higher, and then we felt better about the fact that earnings would likely be growing above average, therefore delivering double digit rates of return. You have to frame that and counterbalance it with what's going on with valuations. The way that I look at valuations simply is just to compare the yield on the 10-year Treasury bond with the earnings yield on the stock market. That's apples to apples. They call this the Fed model. As you can see on the slide I'm presenting, back when the market was overvalued in 2000, the 10-year Treasury yield was 6.5%. The earnings yield on the stock market was 4%. Should have bought treasuries, not stocks at that moment. The stock market corrected, yields came down, made the stock market even more attractive. But if you take it to where we are currently, or were at the end of 2025, you'll see the 10-year Treasury yield at 4.2, the earnings yield at 4.5, markets fairly valued, which presented the opportunity for those above average earnings to simply translate through to returns. So here is what we forecast at the beginning of the year that we would see in 2026. First, we expected the equity markets to go higher, which they have. We expected small caps and mid caps to outperform their large cap brethren, which they have. We expected the style, more cyclical value segment to outperform the growth segment, and indeed it has. We expected internationals to have their due in a world of great optimism, and indeed internationals did outperform into mid-year. We expected the dollar to weaken, which it did, until we attacked Iran, and then it strengthened as a flight to quality coming into the U.S. And then in terms of interest rates, we just think they'd be higher for longer in a world of abundance. Inflation's still high, even if coming down. That supports a higher rate complex. We'll talk a lot more about that. And then from bonds, interest rates being 5% or so isn't necessarily bad because those who own the bonds get a 5% yield, and we expected that those yields would pour through, and they have all the way across the curve, and so 5% is what investors should anticipate. And then in terms of a primary threat, the thing that we were most concerned about was that there would be a reacceleration in inflation, and that might put Donald Trump at odds with the Fed chair, creating consternation within the markets, as well as pressure on valuations. I still think that's a little bit of a concern, but it wasn't debilitating for the market in the first half. So overall, we said prepare to be shocked, and it was a positive shock and outcome in the first half for investors. So now, when I went away for a couple weeks contemplating on the news of the day, what I ruminated on is that I get asked a lot on television or also on the road, are we in a bubble? And I think that's too simplistic a question. It's too binary, it's too reductive. I don't think it's really about bubble or not bubble. I think it's more about bouquet. There are lots of nuances to this market. There are good news things that I will give to a green balloon to. There are things we should be perhaps more cautious in considering, and I'll put a yellow balloon to that variable. And then there are things that either require reinflation or are ready to be popped, and we're gonna go them the color of red for red balloons. So I'm gonna take you through it using that as a framework. First, let's start with the economy. The economy absolutely gets a green balloon, and here's why. It's been fantastically resilient, even through the inflation scare, the tariff scare, the Iran war. It just continues to grind higher. And in fact, what I'm showing you on this chart is that the economic data rolling in continues to outperform the expectations for the economists. And so the higher this line is, and the more green it is, the more reality is outperforming expectations. This economy has really been stalwart, resilient, tireless, and amazing. Question is, how and why? And for that, I'm gonna ask for help and bring in Professor Wall Street. Professor Wall Street is being tasked with reminding us what the components are of the economy. And as you recall from your macroeconomics class, GDP, or the economy, is really just the combination of consumer spending, all of us out there, investments from corporations and also investments into new construction of houses, government spending, and then the impact of net exports, which is imports minus exports. And the combination of that gives you the total sum of the economy, which right now is about $30 trillion. All right, so let's take this apart and look at each one of these individual economies and see what's driving our economic success. First, let's think about trade. Obviously, the dominant story in trade over the past couple of years has been the tariffs. I'm going to give the trade economy a yellow balloon because the trade policy has been so disruptive, but take some comfort in knowing that while Trump may have taken tariffs up to 28% in the Rose Garden back in April of 2025, after court rulings, some taco concessions, we're back to 10% tariffs. We were at about 2.5% to 3% prior to the disruption. So really, from a tariff perspective, we're back to a premium, but pretty much business as usual. So for each of the components of GDP, I'm going to walk through the contribution to GDP. For the trade economy, you can see there are moments where it adds or subtracts a good bit from the economy relative to its size. And we can see some influential events. If we go back to the COVID era, once the economy reopened, there was a whole lot of imports, and that dragged GDP lower. Then the rest of the world reopened. There were a whole lot of exports. That took the economy higher. And then right before Trump stood in the Rose Garden with his menu of tariffs, business owners imported in advance of that, and that took the economy lower. And then as soon as the tariffs were announced, businesses stopped importing, and that ended up being a contributor to GDP. And then as you can see, things have kind of gone back to business as usual. Over time, the average drag, because we're a net importer from the trade economy is about 0.2%, and that's where we were at the end of the first quarter. So the trade economy is definitely not what's propping up the overall economy. So now let's take a look at residential housing. If we look at residential housing, it receives a red balloon because we are basically building houses at a recessionary pace. High interest rates have basically incarcerated U.S. homeowners who have low interest rate mortgages, and so there's very little velocity in the housing market, and that's left home builders in disarray to a certain extent, and also, depleting the supply of housing stock relative to the population. So this just gets a red balloon. And home building over time can be a pretty good harbinger of the economy to come. So obviously we had a housing bubble prior to 2007, and you can see that as a contributor to GDP. And then the housing bubble burst. We had the great financial crisis. That was obviously a detractor to GDP. And then during COVID, we had lockdowns. That ended up being a pretty big detractor because you couldn't go to any open houses. And then you had stimulus and the combination of lower interest rates and fat government handouts gave people money to buy houses, and they did. Then we had runaway inflation, higher interest rates. That ended up being a detractor. And where we stand today is in Q1 a negative contribution to GDP of about 0.2%. Again, as a victim of high mortgage rates, which I really don't see going away. So it's pretty clear that the housing economy is not the reason that we've got a robust overall economy. What about government spending? The government is a big participant in the economy. I give that a yellow balloon because government spending is definitely policy related, can be hard to forecast. If we go back over the last 5 years and look at the influential contributions and detractions, obviously the government spent a lot of money during COVID and then laid off a bunch of people after, and that money receded. And then Joe Biden, through Bidenomics, had 3 massive spending bills, and that boosted government spending a lot and really carried the economy during that period. Now, obviously, there's a debt associated with that, but for the moment, it was very contributory. And then when Trump took office, we had the Department of Government Efficiency start carving out waste, and that led to a drawdown in government contribution. Then we had the 43-day shutdown at the end of 2025. We had the reopening. But if you look at policy today, we think that the cuts from the One Big Beautiful Bill will be offset by wartime spending, and that really just takes us back to average. So I think the government economy will contribute about 0.2% to the economy overall. That is definitely not the source of support for the robust U.S. economy. Consumption. What we spend at the mall accounts for 68% of the entire U.S. economy. So arguably, this is by far the most influential and important variable. So let's take a hard look at it. I give the consumer economy also a yellow balloon, and here's why. If you go back and you look at the contributions over the last 5 years of the consumer, it's averaged about 1.7%. So with GDP at 2%, 2.5%, it is a big driver of what we've seen, but it still vacillates back and forth above that average line. Obviously, back during COVID, we had robust spending because there was robust stimulus, and we all spent that on Pelotons and all sorts of things. And then we had the inflation that followed, and that detracted from spending because it diminished real spending power. As inflation came down, we got real income gains, which augmented spending power, which helped to boost the economy. And then people got a little nervous when tariffs hit. They sort of worked their way through that. If you look at where we are today, and I'm using a measure of consumer sentiment known as the University of Michigan Consumer Sentiment Index, the combination of bellicose politics, war, continued inflation actually has the U.S. consumer more miserable based upon this measure than they have ever been since it came out in the late 70s. And typically that doesn't bleed over into robust levels of consumption. And if you look at the first quarter, that was definitely the case. The consumer contributed 0.4% of the 2.1% that we grew in the first quarter, much less than average. The consumer economy gets a yellow balloon because it is obviously not the contributor to what's driving U.S. GDP exceptionalism. So we have one variable left. The one variable left is business investment spending. And by that measure, this deserves a big, bright green, beautiful balloon. Business investment economy has absolutely been roaring over the last 5 years, and there are a couple of key reasons for that. One, there was a lot of reshoring. After COVID, people recognized the supply chains were not dependable. Biden passed 3 big spending bills to help, renationalize a lot of industries, and some of that ended up being a pretty substantial period of business investment, subsidized by the government, and also the disruptions of COVID. And more recently, we're seeing significant spending on artificial intelligence, capital equipment, and property, building out, enough power to do all of the computing. And it's so substantial that in the first quarter of 2026, business spending alone, which only accounts for 13% of the economy, contributed 1.4% of the total 2.1% growth overall. This is substantial. How substantial is this? Well, what if we had no spending on IT investment and technology? This chart shows you trailing 4-quarter growth going back till 2022 for what GDP would do if there was no technology spending. GDP over that time averaged 2.25%. You can see without tech, we would have been well below average. Here's what it looks like with tech. So all of this tech spending not only has taken GDP well above average, but it's also accelerating in terms of its percentage contribution to GDP overall. And just to put a finer point on this, if you compare the amount of spending in the economy today for AI infrastructure, it is more as a percentage of the economy than the build out of the railroads in the 1850s, the internet in the 90s, the shale revolution in the post-2010s, interstate highway system, and also the Apollo program where we mobilized the country to build a spaceship to go to the moon. That pales in comparison to what we're seeing today across the economy, investment in AI infrastructure. The other thing that all of this investment is doing is creating a bit of an AI gold rush. This is weekly business formations. For productivity to truly be in a period of shock, a much higher level of productivity, you need not only capital investment, but you also need high levels of entrepreneurship, because ultimately it's the entrepreneurship that provides the creative destruction that ends up reformatting the economy and leading to much higher growth rates. And so in addition to having an infrastructure and capital spending boom, we're also having a startup boom, and that's great news for the economy. So if all of that is true, it should be showing up in the productivity statistics, and indeed it is. There is a boom in productivity. This is a chart that goes back to 2005, and it shows you specifically what's happened over the last 3 years, and the productivity gains we've seen have been well above average, and as I postulate, this probably continues for quite a while. And all of this rising productivity should build rising prosperity across the economy. Despite what you hear, corporate profit margins are at record highs, 13.7%. Household net worth up 67% since COVID is at record highs. Household net income is at record highs, up 30% since COVID. So we're seeing record profit margins, record net worths, record incomes, and that should bleed into record returns for investors, and indeed it has. And so if we go back and look at the performance across the markets for the first half, U.S. small companies returned 23% to investors, the emerging markets 22%, commodities, all of the inputs into the boom, were up 18%, mid-cap stocks up 16%, value-style stocks up 16%, large companies up 10%, foreign companies, this is Europe and Asia, up 9%, U.S. growth companies up 5%, and bonds, if you look at total return, we're up 1% or so, even though those yields are around 5%, as I said. The only things that didn't work, gold, why own gold when you can own stocks that go up 20%, and Bitcoin, why own Bitcoin when you can own semiconductors that go up 100%. So it was an extremely prosperous year. It absolutely has played out the way that we expected, but that was then, and this is now. So this is the question that Professor Wall Street wants to ask the class now. Is this indeed sustainable? Well, we talked a bit about capital expenditures on the AI side, and it truly has been a breathtaking run. If you look over simply the last couple years and extrapolate out one more, AI CapEx is growing at 250%. We're getting close to spending $1 trillion on servers and chips and dirt and steel and all the things that go into making a data center to serve basically this endless appetite for compute. And for these numbers, I'm specifically relying on what's known as the hyperscalers, which are Amazon, Google, Meta, Microsoft, and Oracle, the ones that are spending the bulk of the money. But as we look forward, things change a little bit. They continue to power the economy, but they're going to power the economy at a much slower pace. So rather than growing 250% like we have over the past few years, we're likely going to grow about 13% in this category going into 2030. And there's a reason for that. To this point, the hyperscalers, again, Oracle, Meta, Alphabet, Microsoft, and Amazon in this chart, have been financing all of this capital growth themselves out of free cash flow. But you can see, based upon the burden, that free cash flows are starting to tip negative, and indeed into 2027 really will be negative, and that has significant implications for the way these people are financing their investments. So let's talk a little bit about what is going to power continuation of this sizable CapEx investment. Well, for the hyperscalers over the next 4 years, they're going to need to fulfill CapEx commitments of about $4.7 trillion. They also need money to run their own businesses, which is about $3.1 trillion. So overall, they need about $7.9 trillion to build the factories and run their businesses. They generate in free cash flow about $5.8 trillion, which means there's a gap of $2.1 trillion that they are going to have to get somewhere, and that somewhere is the stock market and from the bond market. They've got to finance this growth, and that is new. Okay, let's start with the stock market. The stock market typically takes issuance out of supply. And the reason it does that is because there's a lot of mergers and acquisition activity, and stock market participants, companies have gotten very, very serious about doing stock buybacks, which helps them boost their earnings. So the natural condition of the stock market is actually to reduce net issuance. You'll go through periods where you have a lot of positive issuance. Those periods are typically marked by tremendous amounts of initial public offerings and secondary offerings. We've seen a couple of these where we've seen positive issuance in the past, first quarter of 2000, first quarter of 2001. Now, for those of you that have done a little market history work in your head, those were not particularly good moments to invest in the market because we ended up seeing that issuance obviously collapse. We saw this again in the first quarter of 2026, and what's driving that is the amount of issuance we're seeing really from the hyperscalers. We're seeing IPOs, but a lot of mega raises. So for instance, Google raised $85 billion recently. That was actually pretty successful. SpaceX raised $86 billion with its IPO. They raised it, but now the stock's trading below the issuance price. SK Hynix raised the most money of any foreign company in the United States of America just a couple weeks ago, $26 billion. That was successful for them, but not as much for the investors now that that dips below its offering price. And in the pipeline, we've got Anthropic at a $75 billion raise. We've got OpenAI at a $100 billion raise. That's a tremendous amount of supply and pressure that gets applied to the stock market. So we're seeing this rising equity issuance for the hyperscalers to fund their operations. We're also seeing this in the bond market. So over the past 12 months, there's been $2.8 trillion in new corporate bond issuance. That's really right at the level of the peak prior to the housing bubble. Now, this is not inflation adjusted, so it's actually not as high. But optically, you can see there's a whole lot of issuance going on in the marketplace. And what's driving that? Again, it's the hyperscalers. So on average, over the last few years, they've been raising about $25 billion a year. This year, they'll raise $300 billion. So they will be 10% of the corporate bond market over the next 12 months. That's a significant amount of supply hitting the market. Now, the markets in equities and bonds are deep enough to handle this. The question that has to be asked is at what price? So let's just take a look at the bond market. The way that the stock market deals with this is by discounting share values. The way the bond market deals with this is by demanding more yield from issuers. Here, the yield on leveraged loans on average right now at 8.5%. If you're raising for a software business, it's a little different. So now you've got to raise at 12% cost of capital. And if you look at credit spreads of the hyperscalers investment grade bonds versus non-hyperscaler, non-tech, industrial grade bonds, you're seeing the hyperscaler spreads start to blow out. So the cost of capital is rising for these businesses in the equity market. The cost of capital is rising for these businesses in the bond market. And remember, their cost of capital prior to this was effectively zero because they were generating it in-house. Now, it's okay if you have to pay for capital as long as you have higher returns than the price of that capital. So the question is, how durable are the margins and the business models for this huge AI build-out? Well, there's not really a great pricing mechanism for this other than the price of tokens. So if there's insatiable compute demand, you can figure out how it gets priced, and there is an index for that called the Silicon Data Token Price Index, and token is just a unit of compute. That index price has fallen 15 to 20% since May. That's a concern. Does that mean people are using less compute? It does not. In fact, people are using a whole lot more compute, but they're shifting to lower cost models, specifically in China. And there's a lot of discussion around this, whether protectionism will shut down their ability to do that or not for national security reasons. I do not know, but it's clear that the market is saying, we like the compute, it's a commodity, we'll buy it from the cheapest provider. Right now, that's China. Okay, so if the cost of capital is rising and the return on that capital may be falling, then perhaps this could injure the return on investment within the tech complex. So there are many who forecast that return on equity in the mega tech complex could decline over the next few years. That's not good. However, the beneficiaries of this are the companies who are getting cheaper and more ready access to compute, and that could drive up margins and return on equity for the rest of the market. So bad for tech, good for everyone else. And this leads Professor Wall Street to ask, okay, given all these cross currents, is this still investable for all of us? This is where you can have a little bit of relief and maybe have some optimism. First of all, we don't see a recession on the horizon. And if there are low recession odds, then it's most likely that earnings continue to grow, revenues continue to grow, stocks continue to rise. Remember, no recession, stocks go up 85% of the time. So we're still in the green balloon here. I think the market is healthy because there's no real recession odds afoot. And in fact, analysts have actually been raising their earnings expectations. And so over the next 12 months, analysts expect small cap earnings to go up 18%, mid cap earnings to go up 16%, large cap earnings to go up 21%. And in fact, they've been raising those estimates into the end of June. So lots of earnings, not only in large caps, but all over the cap spectrum. And lots of earnings across sectors as well. You don't see this very often, but all 11 sectors in the S&P 500 will likely see earnings growth this year. Now, unfortunately, war is good for energy firms. They lead the pack with earnings growth of perhaps 67%. And healthcare ends up, in the rear, maybe only growing 3%, but all 11 are expected to show growth, and that's pretty amazing. Even more amazing, there's growth everywhere. So emerging markets are supposed to grow earnings 56%, and you can see even sclerotic Europe is supposed to grow earnings at 15%, well above their long-term average. So a lot of abundance still within the marketplace. And then we have to, of course, screen that against our valuation screen. It hasn't changed much. If you look at where we are from valuation perspective, stocks and bonds are still tied. So as long as those earnings pull through, these markets should be, in aggregate, able to grind higher. But there are some things that we need to consider. In the realm of expectations, things have gotten just a bit frothy. For the S&P 500 overall, analysts today expect earnings will grow every single year by 25.5% over the next 5 years. That's the highest level of expectations we've ever seen and well above what we saw at the peak back in the dot-com era that obviously ended in 2000. But that's nothing compared to what analysts expect from technology. So analysts right now are forecasting that there is no cyclicality to technology and that earnings within the tech sector will go 43.5% every single year for the next 5 years. That seems a little fanciful to us and worthy of a red balloon. And within tech, there has been some disaggregation of returns. Not all tech is equal right now. So as we talked about, Bitcoin fell almost 33% in the first half of the year. Software companies fell about 14.5%. This is known as the software apocalypse, as Claude agents and things like that can do everything that Salesforce did. I don't know whether that's true or not, but the markets decided that AI is a threat to that sector and marked it down by 14%. Even the Mag 7s, the providers of AI, ended up falling 2.5% in the first part of the year, but the suppliers of AI did just great. So if you look at the AI infrastructure companies, they were up about 50%, and within that, the semiconductor companies themselves have been in this Super Bowl market, and they went up 113% in the first half of the year. So there's a real demarcation between the providers of AI and the suppliers to the providers of AI. Should something disrupt the suppliers or the providers, the suppliers look a little bit vulnerable. So let's talk more about that. Everybody remembers the dot-com era. I was coming out of grad school at the time. I took $5,000, I turned it into $100,000, and then I turned it into $2,500. I was somewhere on this chart, except I borrowed money and levered it up even more, which lots of people are doing today. We'll talk about that. So here's the path of the NASDAQ between 1996 and 2003, and you can see this obvious mountain and then a decline. Here is the path of the Philadelphia Semiconductor Index between 2022 and 2026. Eerily similar, somewhat foreboding, worth taking a harder look at. When semiconductors go into cyclical upswings, they have dramatically exaggerated returns. When they go into downswings cyclically, they have dramatic underperformance. I remember being on CNBC recently, having a very live conversation, or rather, are we in a cycle or are we not in a cycle? Is it structural? Do you throw the old playbook out? I find that history repeats more often than gets reinvented, and so I'm of the cyclical camp. And you can see there were moments after the dot-com era where the downside, once the cycle broke, was pretty significant. So semiconductors fell 66% back in 2001, and then recovered a bit, and then we got into the great financial crisis. They fell 70%, they came back up. We had another couple of recent drawdowns, 46% in 2001, when we had some jitters and a bear market in 22. And then in 2025, we had the Rose Garden moment. Semis were down 40%, and that was just under threat of tariffs. When I did this slide, they were down 9.9%. I checked this morning, they were down 20%. So it is not an environment where there's no more cyclicality to semis. Don't be fooled by low PEs. That just indicates that they're very high earnings, and those earnings end up being cyclical. So this is something that we have to watch closely. So now, after all of this, the professor wants to know from the classroom, is this the end? Given the fact that we've seen lots of yellow balloons and many red balloons, one might think it is. Let's dig in and try and figure out what would be the catalyst that would indeed indicate that the party is over. Well, number one is inflation. It's everybody's favorite catalyst to talk about. The Fed's got a 2% target rate of return. I really look right now at producer price inflation, and here's why. It's obvious that oil prices have gone up, so you've got some energy input inflation. It's less obvious but true that IT component costs have gone through the roof, and that's also translating into producer inflation, into corporate inflation. And so if we look at the most recent reading, inflation was up 5.1% for producers, and then ultimately that trickles down to consumers. And so the most recent PCE report, which is the Fed's favorite gauge for now, was up 3.4%. Both of these obviously are well above average, and there's a new sheriff in town. This is a caricature of Kevin Warsh, who is our new Fed chair. On the day that he was inaugurated, I guess, took the oath of office, he stood up there at the podium and he said, "The commitment to deliver on reducing inflation is strong. It's unambiguous and it's unanimous. We've missed for 5 years, and we're going to fix that. Pretty tough talk from the incoming Fed chair. And it didn't take long for the market to bake his stern posture into expectations of future Fed policy. Coming into the year, the markets thought there would be 2+ rate cuts in 2026. At this point in the year, the market now thinks there'll be 1+ rate hike. That's a swing of almost a full % and pretty dramatic in the course of the market. So definitely a rate rethink here and more hawkish concern from the Fed. And it's not just short-term rates that are rising. Here is the Treasury yield curve as we ended last year. Here's where we are today. We're seeing rates rise all the way across the curve, and I think here is why. We're seeing upward pressure on the short end from higher inflation and also tougher talk from the Fed. We're also seeing upward, movement in rates from the middle of the curve because we've got all this hyperscaler debt issuance that we have to absorb. And then lastly, the long end of the curve tends to be more calibrated to the long-run fiscal posture in the United States of America. And as many of you know, because I get these emails, it's not really all that great. And so that ends up putting some pressure higher on long-term Treasury yield. So capital costs are rising all the way across the curve. That could be a catalyst. And then lastly, I talked a little bit about leverage. There is a record amount of options activity in the market today, single-day options, et cetera. There's a record amount of levered ETF issuance. And most recently, margin debt used to buy stocks within accounts was up 55% year over year. That doesn't happen very often. In the past, when that's happened, it's initiated kind of a period of blue Mondays for the market for a while until all of that excess leverage burn off. And so this is more of a short-term indicator, but the market is clearly over-levered and we're prime to burn off some of that leverage, in my opinion. So what do you do about it? Or as investment advisors, what did we do about it? Well, it's very important to use a framework and figure out a strategy, having selected hopefully the right framework. So going back and looking at that productivity boom in the 2000s, going back and look at the way that markets and enthusiasm reacted around that period, it's useful to go back and see how stocks performed once things started to change. So if you go back to the period between 1998 and 2000, what you see is technology stocks, much like semis today, were up about 261%, and that lifted the S&P 500 up 60%. If you were a money manager and you weren't just invested in stocks, you likely got fired. I think Warren Buffett was on the cover of Newsweek in 2000 saying Warren's lost his touch, right? Because he wasn't invested in technology. At that time, outside of technology, healthcare, financials, energy were up about 23%. And then the most defensive areas of the market where Warren liked to traffic were down about 6%, making you look pretty dumb. However, as we know, in March of 2000, the bubble burst. Technology fell just that year, 48%. The S&P was down 11% over that period. And oh, by the way, the forgotten ones were up 24%. In the healthcare, financials, and energy sector. And if you looked at the most defensive sectors, think utilities, real estate, that kind of stuff, was up 32%. This bear market metastasized in 2002 into March of 2003. There weren't many places to hide, but technology fell another 54%. S&P was down 33%. Healthcare, energy, and financials were down 25 on average, which is no fun. Low vol, even that took a hit, down 6%. But if you look at the entire round trip, and let's go back to January of 1998, it's the boom time, everybody's excited. By the time you got to March of 2003, your highest rates of return would have come from utilities, real estate, and things that you absolutely did not want to own. And that's what I think is occurring now, and there's a shift that's obvious within the marketplace. We have entered this moment where it's the rise of the rest. So for discerning investment advisors and for discerning investors themselves, it doesn't mean the bull market's over, but it might mean that you've got to look towards some areas that have been overlooked. And we saw this play out in June. In June, the defense scored. So the healthcare, the banks, the low vol was all up, and then Mag 7 software, Bitcoin, the tech sector, et cetera, was down. And that has continued on into what is now, I guess, the third quarter of 2026. So just to review, Professor Wall Street wants us to make this simple. Get ready for the test. So where it all began was the AI boom. And then we had internal financing, which was fine. That was green. And then we turned to external financing. This is how it ages. And we've got the ability and the creditworthiness to handle that until we get to the point where the issuance is so grand that it starts increasing the cost of capital in the debt market and increasing the discount on equity issuance in the stock market. And once that happens, maybe there's more competition, maybe the entrepreneurs start chipping away. Obsolescence is the key to technology. Creative destruction leads us forward, but also does destroy some companies. Maybe you see some lower capital returns. At that point, the people who provide the money get a little stingier with it, so the capital markets tighten, and then ultimately the capital markets close, and that's where recession happens, and that's when this cycle ends. So, I know the question on your mind, where are we now? You are here. We are not there yet, but this is what we have to be mindful of at this point in the cycle. So with that, let me finish with our predictions for the remainder of the year. I still think equities can go higher, but it's not all equities. I think the market gets choppier. I think it gets more discerning, but I don't suspect that we'll have a recession, certainly not within the year, and that's going to drive markets higher by year end. Still favor small and mid-cap stocks. Again, the rise of the rest theme. The big caps have gotten a lot of attention. It's time for the small caps to get some. Same goes for value. More defensive properties in that style. Think that outperforms and continues to. In terms of the dollar, if the Fed's going to get more hawkish, that's going to put upward pressure on rates, perhaps. That's winsome in the currency markets and should help support the dollar. And right now, the U.S. may have an advantage in the international stock game just because the higher currency ends up helping boost returns here for U.S. investors versus international investors. And then you have U.S. interest rates, which we think will be higher for longer. We continue with that call. And then bonds, you're going to get your 5%. We don't see the recession. Default rates aren't going to rise too much, I don't think. But the primary cost to all of this is now that the hyperscalers have turned to the public markets for funding, any increase in funding costs ends up being the principal risk, I think, for the remainder of the year. And with that, I just want to thank you for putting the time in. I am optimistic. I believe that we are in a productivity boom. I believe that will increase household incomes, household net worths, and that story will continue and ultimately accrete a lot of value to investors. That does not mean that we're not in a moment that could be a bit choppy, but I think you can position portfolios correctly around that. That is our mandate. And with that, I know you're busy. I can't tell you how much I appreciate you putting in the time and attention to review this content. I will end right where I started. It is an honor and a privilege to serve you. And my hope and ambition in this and all of the content that you receive from us will be to be a bridge to peace of mind for you and your family. So hopefully this contributed to that and stayed in line with the mission of our firm. Really would love to introduce Bill Loftus at this point, bring him in and do a little Q&A regarding all of this, and hopefully it'll be fun to listen in.
David, that was absolutely fantastic, and I've got so many questions to ask you. I want to start with one. When you put something like that together, the amount of information is incredible. How do you decide on what the thesis is that you're going to build the presentation around?
Well, thank you for the question, and a quick moment of gratitude for you. So I have to tell you, these firms came together July 1st. I'm having more fun than I've had in a long time. And I'm so enthusiastic about the things that we're going to be able to do together, and also for your leadership and so many client-centric endeavors and the technology and all that kind of stuff. I want to take a moment to say how grateful I am for this partnership and for you. All right, I'm going to answer your question. So part of the reason why I go into isolation for a couple of weeks is because you can only find the diamonds when you're in the mine. So I don't go into those periods with any predetermined notion of what that diamond may be. I dig and 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 I go, there it is, right? So in preparing for this year, I spent a lot of time, obviously reading and researching, and then it just sort of popped up to me that not only was it going to be a productivity boom, but there was going to be a productivity shock, right? And so there are things that make people uneasy about shocks, but there are also in history those shocks that just create unbelievable levels of abundance and prosperity. And so once I had the proper frame around it, then I could go back to history, study those moments, and use that to inform the decisions not only in the presentation but for the portfolios. So you got to put in the work. In fact, while I'm vamping on that, I just got a text from somebody who sent me their market thoughts on the day. I don't know whether ChatGPT did that or not, but it's a little bit more advanced than I would have thought that individual might have been. To the extent that everybody is using the same engine to come up with the same market comments, that's really vulnerable, right? That goes back to sort of long-term capital management, the smartest guys in the room. Everybody was doing the same thing. Nobody knew there was systematic risk in the portfolios. So to me, I don't want the AI doing any of that thinking for me, because I think that's a risk in the marketplace today. So it's got to be organic thinking. It's got to be in isolation. It's got to take some time, because the mining is the work that has to be done to find the diamonds.
Great. I mean, I think that's so important. I've been in the investment business for 40 years. And, the thing I always say to the people back at Coastal Bridge is, you've got to separate fact from fiction. You've got to take the emotion out of it. And I think your presentation had just an incredible amount of authenticity to it. And I want to talk to you a little bit about productivity. Your message was cautiously optimistic in general. On the one hand, we've got this incredible productivity boom. On the other hand, we have some things out there that are potentially troubling. And, they say that history, probably the worst or the most important things to remember on Wall Street is this time is not different, okay? We've seen how this plays out in the past. You and I both lived in 2001, 2002. What's the message to investors? What's our role as investment advisors to assure that people don't suffer through a market like that?
Well, I think it's really interesting if you dig into the periods when people suffered in the markets. So, yeah, I remember the 2000 bubble vividly, and I also remember running money during that next decade when the S&P went nowhere. It went nowhere. Yeah. So if you just bought that one instrument, which by the way was what they told you to buy between 1995 and 2000, had great concentration risk in it. It was the only thing, it was the set it and forget it portfolio solution. And so the people that owned that, they made no money for the next 10 years. I was young in this business. I saw opportunity in small caps and value and sectors that were forgotten. And over the next 10-year period, we outperformed the market a lot over that period because the market was so broken, right? And so there are always areas that you can rotate to find rates of return. So just because the indices are in a bear market doesn't mean our investors can't be in a bull market. And so the responsibility for the responsible advisor is to move the capital around where the opportunities lie, and often you have to be contrarian, right? So as I talked about in the presentation, Warren Buffett was ridiculed in the late 90s. Berkshire did great over the next 10 years, and the S&P did terrible, right? So you have to be contrarian, you've got to be brave, you got to be willing to take risk in some ways of ridicule, but you got to stay attuned to the craft and know that what we've got to do is compound money over time for investors, keep them in the markets over time, because that's how you get the compounding, but rotate within the markets to the areas that are most favorable. So what I'm seeing right now, and I remember having a conversation on CNBC recently where I said, if this is not a bubble, we are doing it wrong, right? Like, this is so exciting and it's generating this gold rush mentality. It should be a bubble, but that doesn't mean that we can't find ways to protect ourselves through this period. So I actually think the bubble-ish kind of activity in semiconductors and everything else is just a further indicator that we're in a productivity shock, because there's so much enthusiasm around it, but we have to be sober-minded, especially when we're allocating clients' hard-earned capital.
Yeah, no, I hear what you're saying. I mean, the thing, when you broke out what's the contributors to productivity, clearly corporate investment is front and center.
Yeah.
And it strikes us that a lot of the heavy lifting is done by the Mag 7 and the hyperscalers, who, based on your charts, look like maybe they're getting a little bit long in the tooth, and there's some troubling signs there. What's it going to take for the rest of stocks in the S&P 500 to sort of, assume their share of the responsibility?
I think that's a profound question, because if you go back to that look at the productivity period around the internet, the darlings of the day are not around.
Right.
The only company that remains on that chart, AOL, gone, Netscape, gone, BlackBerry, gone. The only one that survived was Microsoft, because Microsoft, had Microsoft Windows, and now you see Microsoft in trouble now, because it's like, well, is Microsoft vulnerable because AI can just do software things? So I think, there's an obsolescence that occurs naturally in periods like this. And so initially you're gonna have the people that can afford it, build the expensive models, plow us forward, and then you get the competitors who come in, kind of like the DeepSeek moment, where somebody says, well, I can do that for 30% less. And suddenly that competitor looks a little vulnerable, right? And so I think there'll be a democratization of this as it proliferates across the market. I also think, Karp's moment with Palantir was very interesting, because what he said was, if you've got the recipe for Kentucky Fried Chicken and you put it into your Chat GPT or your Anthropic or whatever, everybody has that now, right? So how do you protect your sovereignty? And I think about cyber security threats a lot for our client base, which is large, and we're tasked with protecting them. For the stuff that we really want to do and dig into, and a lot of the things you're working on with AI, we probably want to do that in-house. We probably want to have that data well within our walls, and we want to work with the data within our walls, because I'm not sure that it's comfortable, safe, and secure to be ferreting that out. So we went to the cloud for years, and people were worried about that. It ended up being secure. Then people started putting some servers back in their office, right? So the pendulum may swing back in this game, where the businesses themselves end up hosting their own LLMs, and that could be a threat a little bit to the hyperscalers, but I think it's a good thing for businesses and the security of client information overall. So I think we'll democratize, things will get cheaper, we'll be able to do it ourselves, and that's going to be exciting.
So that's a hopeful message, because the concept of, and that's really what AI has been about, is the democratization. It's the fact that it levels the playing field. But it also, the speed, the rapidity of change these days is incredible.
Yeah.
Back in 2000, 2001, we didn't have this kind of change. It took years and years for Microsoft to get back to even, by the way.
Yeah.
If you bought Microsoft in 2000 or 2001, I think it took you like 10 years to get back to even.
Oh yeah, at least.
This feels like it's going to be different. The pace of change is so incredibly different. How do you, investor sentiment plays such a big role. How do you get out of the Mag 7? The Mag 7's been the heroes. They've done all the heavy lifting in investing for the last 10 to 15 years. How do you skillfully get out of them? What would you tell a client who's got big gains, is concerned about taxes, but knows they probably have to start migrating some money out of those names?
Well, it's kind of like, I don't go to Las Vegas often, right? Because I get enough thrill trying to manage money for a living. But if I'm at a table and I'm up a lot, I walk away, right? Like the whole idea is they pump in the oxygen, they give you a drink, and you stay there until you lose all your money, right? So, if you've got a big advantage over the market, if you're in SanDisk and you're up 4,000%, you've won. Take that, buy an index, and you're better than Warren Buffett over the next 30 years, right? In terms of your rate of return. So I think for those that really want to play with individual positions, and for those who want to gamble a little bit on, whatever the hot dot is, when you win, you have to walk away. I will say that great investors, more so, are those that are great sellers and not great buyers, right? Because there's always more, it feels like seller's remorse. Like, well, I've ridden this horse for a long time. I don't want to pay the 20% capital gain, so I'll just hold it through that period. Next thing you know, you're in Microsoft for 13 years treading water, right? When you could have been on Snap-on or something else and made money over that period of time. So I think it's hard behaviorally for people to sell their winners, but intuitively, those are the ones you should be selling, because this is a very difficult business, and at the end of the day, you have to have the discipline to buy, you have to have the discipline to sell, and you're also predicting the future, which, especially in a moment where there's this much disruption, is particularly hard to do.
Right, exactly. Okay, so a new client comes in tomorrow, and they've got money to invest. Maybe they sold a business, or they've left a company, and they've got liquidity, and they want to put money to work. What do you tell them?
I tell them, and I go back to what's cornerstone in that presentation. Number one, we're not in a recession,
Okay.
right? And so there's a good probability that the market rises. Number two, there are areas of the market that we talked about. They're a little bit yellow, maybe a little bit red, but there are other areas that are green. So we're going to focus on allocation. I would probably also say, from a seasonality perspective, we're in the soft part of the calendar. Between now and Halloween ends up traditionally being kind of a rough ride. And so I would probably advocate to dollar cost that money into whatever the prescribed asset allocation is, which will come from the financial planning. The financial planning over time adds so much more performance than the investment management. That's where the alpha really comes from. So once I know what the asset allocation called for by the financial plan is, and I know we're going to be 60% equities, then I would probably advocate to dollar cost average it in between now and Halloween. And by the way, if something happens, the market breaks, it falls 30% on a Tuesday, we accelerate the purchases. So I think you leg into the market, specifically in this period of the calendar. You take advantage of disruptions, but you let the asset allocation drive the overall investment.
Yeah. You just hit on something I want to develop a little bit more. It's this concept of consistency in the marketplace. It's the concept of dollar cost averaging, taking the emotion out of it. Talk to me a little bit about how you've developed your philosophy on that over the years and how you've seen it work for clients.
Well, I spend a lot of time. In fact, if you crawled into my brain, you would notice how boring it is.
Scary thought, by the way.
Mostly, it's just probabilities,
Yeah.
right? You can't predict the future, but what you can do is use the past to say, what is the most likely outcome, right? And we get whipsawed around a lot. I'm surprised and amazed at how behavioral the markets have become. I also think it presents an opportunity to take advantage of that. So when ChatGPT says sell all your semiconductors, okay, well, let's see what happens there. Semiconductors, the bottom falls out, and then we get an opportunity to buy them, right? Because it overextends, because there's too much behavioral fervor around an idea. So I think long-term investors, and that's who we are, and that's who our clients are, can take advantage of more behaviorally sort of responsive short-term investors. So when we get into periods of volatility, that's catnip to somebody like me, right? Because that's where the discounts appear. And we may be in a period like that now, and the right side, the growth side of the style box today is very red. The value side, the left side of the style box is very green, right? Which is kind of dramatic, but that's the environment that we're living in. So I think it's incumbent upon long-term investors to use probability, use patience, and I think it's providing even more opportunities to take advantage of sort of the hyperactive short-term investors. And so if we're in periods of dramatic leverage like we are, and it bottoms out, there's just going to be so many good things to buy. It's like a development. Like you know a lot about real estate.
Yeah.
Like you don't want to be the one who actually develops it. You want to be the one who buys it after the bank has it. Right. So I think this kind of volatility creates lots of opportunities for long-term investors and a lot of stomach acid for short-term investors.
Right. That's well said. I want to develop that a little bit more, okay? Because the concept of long-term investing, I think, is essential to being a successful investor. You've been a long-term investor. Your family has been in the investment business. I mean, Waddell and Associates was started back in the 80s. And I love, can you share with us a little bit about, some of the immutable truths, the things that you grew up with that were passed on from your father and your mother to you that have really framed who you've become today as an investor?
Well, first of all, part of the reason why I put so much effort into this is that I believe that when clients, there's this moment of reverence that occurs in our business where somebody walks in, maybe they're, 50, 60 years old, maybe they've amassed some wealth, and then they trust you and they push it across the table and say, you're in charge.
Right.
Like that is a massive moment, a massive responsibility. And I would never want to shrink from that. So I will always put in the work to honor that trust with the kind of effort that it takes to put in a proposal like this. And so number one is our job is to honor the trust that people have in us. Number two, what I recognized, when I was young, I remember thinking, I'm still young, just not as young.
For the record.
I remember thinking at the end of the year, I'd mark our performance next to the stock market, and I'd be like, I won, right? Well, here's the thing. You never win.
You never win.
Right? I mean, it goes on for forever. Performance is not what happens in a moment in time. It is a discipline. And what winning looks like is that the client gets to their 100th birthday, and the kids have been educated, and they've lived everywhere they want to live, and they, never had to eat cat food on the beach or anything like that. That's what performance looks like, right? So the vagaries of the market just provide us the opportunity to compound money as called for by the financial plans. But the real market performance is not, did you beat the market? It's, did I get you to 100, and did all your hopes and dreams come true financially? That's the assignment.
Right. That's their index, right? It's
Correct.
not the market.
They are the index.
They are the index, exactly right. And that's something, that's a truth that we believed at Coastal Bridge for a number of years. I've always said we are a planning-based investment firm because we start with the plan. And whenever we have situations where, the inevitable market disruption, the thing we always do is we go back to the plan and we check in with the client and we talk about their personal goals, we talk about their objectives, and we tell them where they are in relation to those things.
Yeah.
That's what matters.
Well, and let's think about a downturn, right? So if you take the average investor balance sheet, their biggest asset typically is their house,
right,
or their real estate portfolio, or maybe they're in a private business. That's a big chunk of their balance sheet.
Sure.
So let's just say that the stock market is 10% of their balance sheet, or let's say 50%. Let's say it's 50%. Right. Market goes down 50%. Right? I mean, they are gassed. They're like, oh my gosh. But when you weight it for the fact that it's only half of their balance sheet, and by the way, the probability theory that we use in financial planning has already contemplated these markets.
Right.
And so then you go back to what's the most important number? The most important number is not the market is down 50%. The most important number is the probability of your financial plan working just slipped from 92% to 88%. How do you feel?
Right,
You're
right,
like,
exactly.
I'm good. Right?
Exactly.
So we get drawn in, and I'm part of it to a certain extent by what's going on TV,
yeah,
right? And it's very exciting, but we lose perspective on the fact that the balance sheet is much bigger than NVIDIA, right? And the probability of success in the financial plan is really the number you should pay the most attention to. And when markets draw down, Monte Carlo theory within the financial planning process has already contemplated that, and your probability of success really hasn't gone down that much.
Right. Exactly. It's so funny, when you go through periods of market downturns, no one wants to lose money.
Right. I don't either, by the way.
No.
It's worse for me.
But that's the point where we get to really do our job.
Yeah.
That's the point where we can draw on all the experience that we've got, having seen markets, understanding kind of how they work, knowing the individual client that we're helping, and being able to help guide them through that.
That is mission critical, and the moments that have been most successful in our firm in the past have been those moments, and here's why. Markets periodically will just, you'll have a meme that falls apart, or you'll have something, or you'll have COVID hit. I remember COVID. COVID hit. Market goes down. Advisors were hiding under their desks. What do we do about this?
Right.
It's a pandemic. Now the clients are calling. So I went and crawled into the cave. I spent all the time, and what I figured out was the best analog for COVID was the flu that happened in 1958 and 1959. It wasn't the Spanish flu it was the Asian flu. 1 million people, population adjusted, died. There wasn't much stimulus. There was a voluntary quarantines, et cetera. So important to the process. Go back to history, find the framework, and then dial in and figure out what happened. And what I figured out from that moment was that animal spirits went through the roof once there was a possible vaccine, right? And then you couple animal spirits with the government stimulus, with the monetary stimulus, and I was like, this is going to roar when we get on the other side of this. Sure. And in fact, I said that on TV one day, and they said, you can't say that. Because it was, it wasn't sensitive enough. But the truth of the matter is, we got on the front of our feet, right? We got on the balls of our feet, and that's where we lead the clients. In those times that are darkest, being on your heels does a total disservice to them. So you got to have some courage, you got to do the work, and you got to lean in to those down markets. And you better come up with some solutions. Otherwise, why are they paying you?
Right.
Why do they need you?
Right.
So COVID ended up being one of the biggest growth drivers in the business. And I remember somebody came into my office, and they were a wholesaler from a mutual fund company, and they had a slide deck. And they put it in front of me, and I said, do you realize these are my slides? So I think it is our responsibility during those moments. We got to do the work, and then we got to be up front with the communications to help calm them in those moments. So that's a very important point. Right,
great. A couple more questions for you. What makes you most proud? I mean, you've got 30 plus years in this business. What are you really proud of?
The hardest thing about this business is staying in it.
Okay.
Right? Think about that.
Yeah.
Think about who your competitors were when you started out.
Right.
Right? And how many of those people are still thriving and providing value for their clients. So I think, consistency and effort is really the hallmark of a successful business. So the fact that, our business, which is now mutual, has been successful and solving, problems for clients, and we lose very few clients, and the fact that we've got a long track record of tireless consistency that has produced results, the results being the success of the client, makes me very proud, right?
Yeah.
So maybe I'm getting older and soft. I mean, if you'd asked me that when I started, it would be, I'm going to outperform the market by
Right.
5% every year for my
Right.
entire career. You know what? That doesn't matter. What matters is getting those people to their vision of success. And we've done that for a lot of families.
Yeah.
And that excites me, and I can't wait to do it for more.
Right. With all the changes going on in the world and in our business, where do you see 5 years, 10 years out? What do you see happening with Dave Waddell, with Coastal Bridge?
Well, I think that was a lot of the incentive for us to come together. Coastal Bridge has a big budget and no legacy systems, right? I mean, we have the opportunity to white page and greenfield the perfect advisory system
Right.
with the technology available for the day. A client-centric system where everybody recognizes if the clients are successful, we're going to be successful. A budget that will allow us to do things in the technology stack, because you can't have many people wearing many hats and really be successful in the modern age. You've got to have specialists. I mean, I know about AI from the stuff I've said. If you gave me the Claude code and said, go to work building our new portal, I'd have no idea what to do.
Right.
I mean, I can barely find my way in and out of buildings. Like, you've got to have specialized talent for that. So I think we've got that. But I think we're going to live, I get so much junk mail, and Christina, my fiance, gets catfished all the time by AI, with images, and she's like, their toilets falling from the sky. They're really not. So we live in a post-truth world.
Right.
So the premium on human contact, the premium on trust is going to be much higher in the future. So it's incumbent upon us to ensure not only that our advisors are really well trained and very competent, but also good communicators and highly trustworthy, right? So I think there's going to be a premium placed upon ethics in a world that feels like post-truth. And so it's the golden age for advisors.
Right.
I am not worried about AI coming in and taking my job. In fact, if as an investor, all I'm doing is using the AI, then I'm doing a terrible job, right? The thought, the human contact, the currency of trust is going to be everything in the future, and that's where we excel.
Yeah, that's incredibly well said. That's incredibly well said. And I think that you've just articulated in a very elegant fashion exactly what we're trying to build at Coastal Bridge. And the concept of the human element, the concept of accountability, the concept of integrity is what we're going to really focus on and really play to our strength in the future so we can do great jobs for our clients.
Absolutely.
I have to tell you, thank you for your kind words at the beginning, and now it's my turn. This is an honor. It's an honor to spend time with you, Dave. It's an honor to call you my teammate. I'm as excited as I've ever been. I've been in the business for 40 years, and I feel like I just got a new uniform. Remember when you're like a kid?
It's a beautiful suit, by the way.
Oh, thank you very much. But it's like, remember you're 10, 11 years old and you're playing baseball and you got the new uniform, and how excited you were and how it elevated your game.
Yeah.
That's how I feel today.
Yeah, me
And
too.
Yeah. And this is the best of times.
Yeah, I'm excited.
Yeah. So thank you very much. I'm excited for more halftime reports. If I'm fortunate enough to come back and be able to do this with you again,
We'll see what the reviews
I'm
come
here.
in.
Yeah, well, I know. I'm like a guy in a 10-day contract, let's face it, okay? But no, seriously, this has been amazing.
Thank you, my
Thank you,
friend.
buddy.
Appreciate it.
You bet. That wraps up our 2026 Midyear Report. Thank you, David, and thanks to all of you for joining us. If you have additional questions, please don't hesitate to reach out to your advisor at Coastal Bridge. If you'd like to learn more about how to become a client at Coastal Bridge Advisors, visit our website at coastalbridgeadvisors.com.